Okay, let's unpack this. We've got this really fascinating stack of sources here, all about company analysis. And our mission today really is to cut through the noise and give you that shortcut to being, well, truly informed. We're diving deep right into the heart of fundamental analysis. So looking past the big picture stuff, the economy, the industry, right down to the nitty-gritty of one specific company, the goal. To really understand its investment potential, maybe uncover some hidden risks, and spot surprising opportunities.
Exactly. And what's interesting here is we're moving beyond just, the surface numbers. This kind of deep dive into company analysis helps us gauge actual or expected profitability. It reveals what's genuinely driving a company's value. It's kind of like learning to read between the lines of a financial story.
And that story, it starts with digging into the financial statements, right? We're talking about a company's ability to grow revenue, maybe new products, new markets, or how well it's controlling costs, operating costs specifically. But here's where I think the real detective work starts. You have to scrutinize the notes to the financial statements, looking for those subtle warning signs. Like, think about it. A sudden change in accounting practices, one that maybe makes revenue jump without a real operational change, or a quick change of auditors.
Right. And that raises a critical question. Why? Why would a company do that? Now, these changes aren't automatic red flags, like you said, but they definitely demand a closer look. You need to understand the reasons behind them. A company might be, subtly managing its image, or maybe that change in auditors signals a fundamental disagreement on how things are being accounted for.
Mm-hmm.
It's really about looking beyond the numbers on the page to the motivations, the conditions driving them.
Yeah.
You always want to ask, why now?
Mm-hmm.
It's a bit like a relationship ending. Sometimes it's amicable, sure, but other times it points to deeper issues, maybe irreconcilable differences in management approach.
Okay, so if we're playing financial detective here, what's the biggest mistake people tend to make when looking at these numbers? Because, like, a single ratio on its own doesn't tell you much, does it?
Absolutely not. That's a key point. The real value, the magic of financial ratios isn't just the number itself. It's all about the context. Think of it maybe like a single chess piece. Yeah, it's got its moves, but its true value only really shows up when you see its position on the whole board, how it relates to the flow of the game. So for you, this means using trend analysis. You compare a company's performance year after year, see how, say, TransCanada Retail's earnings per share have fluctuated over time, and crucially, you compare it externally against similar companies or industry standards. That's vital.
And what can that external comparison show you that just looking at the company alone can't?
Well, take TransCanada Retail's asset coverage ratio. It's 5.4 to 1. Okay? On its own, that looks pretty strong. But then you compare it to the industry standard for retail companies, which might be, let's say, just 2 to 1. Suddenly, you see TransCanada isn't just strong, it's exceptionally strong compared to its peers. That context gives you such a crucial perspective. It shows if a company is genuinely outperforming or maybe just kind of average for its sector.
Okay, makes sense. So context is key. Now, let's talk tools. We group these ratios into what, four main areas: liquidity, risk, operating performance, and value. Each gives a different view, right?
That's right, 4 lenses. Starting with liquidity, let's look at the working capital ratio. TransCanada Retail has a healthy 2.84 to 1. That indicates, a pretty robust short-term liquidity, $2.84 in cash and equivalents for every $1 of current liabilities. But then look at the quick ratio, sometimes called the acid test. It excludes inventory, and for TransCanada, it's 0.74 to 1. Now, that seems lower, but for a retailer like them, with high inventory turnover, that's often quite satisfactory. Their stock converts to cash relatively quickly, so it isn't necessarily a worry.
Got it. Okay. Shifting gears to risk. The interest coverage ratio for TransCanada is 8.21 to 1, so $8.21 in profit for every dollar of interest they owe. That sounds like a solid safety margin.
It is, and it's particularly important for retail companies. Their profits can be more volatile, compared to maybe a regulated utility with super stable income. We also need to look closely at the debt-to-equity ratio. That shows how much the company relies on borrowed money versus the shareholders' investments. And this brings us to the idea of leverage. Having debt or preferred shares, it can really magnify earnings swings, makes them rise faster in good times, sure, but also fall more quickly when things get tough.
Right. And then operating performance, we've got ratios like gross profit margin, 35.50% for TransCanada, and net profit margin, 2.75%. These tell us how efficiently management is using resources, right? And turning revenue into actual profit. And the inventory turnover ratio, you mentioned that earlier, 3.13 times a year for TransCanada. That seems super important for a retailer, showing how efficiently they manage their stock.
Absolutely crucial for retail. And finally, we get to value ratios, things like the price to earnings or PE ratio. For TransCanada, it's 8.41 to 1. This gives you a quick benchmark, tells you how much investors are willing to pay for each dollar of earnings, lets you compare it with others in the same industry. But, word of caution, a low PE isn't always a bargain. It can signal problems the market sees. And a high PE might mean high growth expectations, or maybe just a bit of a bubble. Earnings per share, or EPS, like TransCanada's $3.12, is also fundamental, helps you judge what an appropriate market price might be.
And it's not just about the numbers, is it? There are other factors like the quality of management. That's hard to quantify, but seems essential. And the liquidity of the shares themselves. How easy is it to buy or sell without massively moving the price? Plus, this whole analysis thing, it's not a one-and-done deal. It needs continuous monitoring, keeping up with reports and news. Oh, and one more point, not all shares are the same. Preferred shares, for instance, you assess them differently, don't you? Focusing more on dividend coverage and the equity cushion because of their fixed dividends. They act a bit more like bonds.
That's exactly right. Preferreds need a different lens, focused on stability and safety of that fixed payment. So as you can probably tell by now, really understanding a company's financial health, its true health, it's a multi-layered journey, goes way beyond just a quick glance at a stock price. It's really about asking the right questions, knowing where to dig for answers, and applying the right tools correctly.
So if the big takeaway here is the importance of context, comparing trends, comparing against peers, maybe here's a thought for you to chew on. What assumptions might you be making just in your own daily decisions that could really benefit from a similar trend in an external comparison approach? Something to think about.